Hey everybody, how's it going? My name's Chandler Sampson. I'm a loan officer and a real estate agent, and actually an investment enthusiast. So I look at a lot of things finance, and I wanted to go over a few things with you today to talk about the relationship between the federal funds index rate for interest rates and mortgage interest rates. And a lot of people don't understand the relationship between the two. They think they're one and the same, but in actuality, what a lot of people miss is that there's can actually be an inverse relationship between mortgage interest rates and the federal index fund rate. So, this past year, since January, you've seen mortgage rates go on quite a bit of a run. They've almost doubled since December, more than doubled actually. And the reason why that happened, they think, is because a lot of people speculate that because they knew the Fed was going to raise their federal index rate. However, the reason why it happened so quickly and why mortgage rates went up so much so fast is because the Fed failed to act. The Fed index rate actually helps combat inflation. So we had all this inflation going on that we knew about since last year with supply chains and all this demand that's still out there, but people aren't able to get the goods and stuff, items that they need. So they saw the rise in prices and they saw the inflation getting out of control. If the Fed would have came out in January, December and said that they were going to raise their Fed index rate, that way that would kind of cool off some of the demand in the economy, slow down some of the demand, and show that they are actually trying to combat inflation, then mortgage interest rates would not have gone up so quickly. Now, they would have gone up more than likely, but they wouldn't have gone up as much and they wouldn't have gone up as quickly. So what happens when investors see that the Fed is not doing anything to combat inflation by raising their Fed index rate, they start to see mortgage-backed securities, which are, is actually the shares of mortgage loans that are held by the federal government, as more risky because they see runaway inflation and maybe an economy that could be doomed to crash. Okay? And so they start investing in bonds and they start investing in safe bet items that they know their money is going to be secure in, right? However, once the Fed came out just last month and announced that they were going to raise the Fed index rate by 50 basis points, mortgage-backed securities started to level out and rates kind of stopped rising, and we've been kind of at a steady level ever since that announcement came out. And it goes to show that once the Fed did this, investors saw that mortgage-backed securities are actually still a stable investment because the Fed is coming out to fight inflation, right? So if you don't have runaway inflation, if you can taper inflation, then mortgage-backed securities are still a solid, safe investment for investors, right? And so when we talk about all this stuff, we kind of have to look at the Fed and what the Fed is made up of and why they do this. So the Fed has, and you can look at this back since the creation of the Federal Reserve in the 1970s, they play a balancing act, right? To where with the Federal Reserve and the credit that they lend, they have two things that they have to balance, okay? One is unemployment and two is inflation, okay? And you cannot have, zero inflation or low inflation and low unemployment for a long period of time. You have to have one or the other. So when there's very low unemployment and there's a lot of demand out there, what happens? Inflation starts to go up. The cost of goods start to rise. And that's when you see it hitting people's pocketbooks. So in order to balance that, the Fed must raise their federal index rate to kind of increase the cost of borrowing money and, disincentivizing people to borrow that money, whether it be for businesses to grow new projects, and kind of slow that demand. But that puts a hamper on the economy. So when that demand dies down, then what happens? Less employees are needed. and so unemployment starts to creep back up. And so there's a fine balancing act that the Fed has to do in order to kind of satisfy both parties. And as cruel and mean as that sounds, that means cooling off the economy. Unemployment may go up a little bit, but that's to taper the price of goods. Okay? The difference is are they experienced enough to do that, the people that are in the Fed, and why do we trust them to do this? And shouldn't they actually have some real world experience? And if you look at it, everyone in the Fed who works there probably never had a real job in their life. One of their first jobs out of college was working for the Fed. So they've never known working in the real world. They have all this calculus of how things look on paper, but they don't really see how economies work in the real world. And so that's where you get some of this erroneous decision making that leads us into terrible situations, because political factors come into play, right? And so people think, it hurts their politics more than anything when they have to come out here and they have to say that we're going to raise the Fed index rate, and it's going to hurt the economy. Because even when you say you're going to hurt the economy a little bit, even though we have very low unemployment, it's a negative sentiment to the people, and they don't like it, right? Because it could mean layoffs. And you've already seen a lot of companies actually mortgage, Robinhood, stock investing companies, Rocket Mortgage, started announcing layoffs. Now, it was a little bit premature because you saw once they raised index rates that interest rates stabilized, and there's still a lot of this about a soft landing possibly happening instead of a recession. But what most people don't realize, because you don't usually know it until after the recession, is that we're most likely already in a recession right now, because we've had one negative quarter of GDP. So demand has already been cooling, but really it's not that, it's the supply chain issues. They haven't been able to deliver supply. Demand is still going down, the interest rates are going up, and so before too long we'll have another earnings report at the end of the next quarter that shows two negative quarters of GDP, which would indicate a recession, which we're already in right now. And that scares a lot of people. I don't think it should, because if you look at the streets and you look at people are busier than ever. They're getting more done than they ever have in the past decade. The unemployment is at one of its lowest levels in history. Now, does that mean that the Fed acted correctly and they did everything right? No. They're going to continue to probably screw it up, and it's going to hurt them politically, and it should, because they played politics first and didn't want to take action against to help supply chains, to help businesses that were dealing with these issues, and to go ahead and raise the federal index rate last year when they probably should have, and kept the economy at a nice pace without causing a recession. So that's on them. But I want you to comment on this video. I want you to let me know what kind of questions you have as far as the relationship between mortgage interest rates. If I think there's going to be a crash, short answer to that is no, it's not going to be a crash, because there's no inventory. Even before COVID, we had about 1.5 million houses on the market, and the average day on market for houses was 45 days. Right now, we're still less than 20 days, and there's only 600,000 houses on the market. So not going to be a crash in that aspect. There may be some slowdown with certain sectors, but really what needs to happen is the supply chains need to open up. China is in lockdown. They need to open up their country, and that will help ease some of the pressure on supply chains and maybe help some of the prices as well, while the Fed continues to hike their Fed index rate. But comment down below. Let me know what kind of questions you have about the Fed, about the index relationship to mortgage interest rates, or about mortgage questions, financial questions in general, and I'll be happy to answer those. All right, thanks very much, guys. Have a good one.